Okay, it's my pleasure to introduce Gray Reinhard, who's the Chief Technology Officer and partner of Energea. He's going to talk about solar as a high yield and impactful. And take it away, Gray.
Great. Thank you, Peter. And thanks for having us on this summit. Okay. All right. As Peter said, my name is Gray Reinhard. I'm a partner and CTO at a company called Energea. And today we're going to talk about democratizing access to high yield solar investments. That's what we do as an investment app company here at Energea. So let me first go through. Okay. An overview of the problem and opportunity that we saw here at Energea. So first, the global power sector is responsible for 42% of global CO2 emissions. This was in 2023. So really, we think, any strategy towards curbing climate change is going to have to primarily address a shift in technology to the way that we power the global utility grids. Furthermore, renewable energy development is underfunded by about 60% annually. So what this means is that the shift to green technologies for our utility grids, it's not a technology problem. It's really a capital problem. There's plenty of demand for this shift. It's just underfunded. So the real problem here is to find that source of capital to fund this development. And so finally, retail investors control over $30 trillion in US capital, but they have historically lacked access to renewable energy investment opportunities. So considering these 3 points, at Energea, our goal was to find a way to enhance access to really profitable investments in the renewable energy space to the retail investors of the US. And so this is small businesses, individuals, IRA holders, family offices, so non-institutional capital. Okay. So there are three macroeconomic trends that make this really good timing for a product like ours. Number one, as we talked about in the last slide, sustainable infrastructure is growing globally. We estimate the global trend towards low carbon infrastructure to require $5.8 trillion each year for the next 15 years. So this is marking a demand in profitable renewable energy development that has been unmet to date. Last year, I think just under $2 trillion went into the entire renewable energy infrastructure global spend. So that's about a third of what we need is going into that sector. Number two, expanded access to private markets. The Jobs Act of 2012 opened up access to private markets for retail investors by modernizing security regulations like Regulation A+, allowing investments in private companies and startups. So typically, the way that you would be able to invest in a renewable energy company would be you'd have to go to the public market for a publicly traded company, which really doesn't work well for real asset holdings like individual projects or groups of projects. So what the Regulation A exemption allowed for is that you can now sell investments in products that are regulated by the SEC, but they don't have to go through the IPO process of going up in publicly traded markets, which really makes it possible to be able to raise investments for this asset class. And finally, the digitization of personal investing. There's a huge trend of investment capital of individuals moving over into app-based investing. So companies like Yield Street, Coinbase, Robinhood, et cetera. More importantly, though, it's for a company like ours, it's feasible to manage tens of millions of dollars across thousands of investors in a complicated asset class. So that digitization of personal investing makes this whole ecosystem possible. Okay, we'll go to the model that we have for how to invest in renewable energy. What we do at Energea is we identify high potential markets globally. So we look across the globe. We see where we primarily do solar. So we'll see where solar is a viable technology in a market. Then we'll look at what's the differential between the price to build a megawatt of electricity and how much can we sell that electricity for? Simple as that. And then we'll look at, say, the outlook of the foreign exchange rate, things like that. And we'll find the most profitable areas of the planet to build these projects. Step two, we'll raise funds for these projects on our platform under the SEC Regulation A exemption that I talked about. in exchange for equity shares in the portfolio's projects. Essentially, you come onto our platform, you make an investment, and you receive equity shares in the group of projects of the market that you're investing in. So over on the right here, you can see these are our current operational projects. So you can invest in either the US, Brazil, or Africa today, and an investment in those markets would give you an equity share in that collection of projects. Number three, the projects are built or acquired using the capital raised on our platform. So we receive the money when we have enough money to build the next project in that market. We send it on down to our construction partners and build the project. And finally, 4 monthly profits are distributed pro rata to shareholders as cash dividends. So the off-takers of the electricity of the projects, they pay their monthly utility bill. We take out the operating expenses at the project level, and we distribute the rest, the profit pro rata to the shareholders. So that's our model. It's an equity holding. But why do we do an equity holding? Right now, you see much more common is if you were to be a retail investor looking to invest in renewable energy, you would either invest in a publicly traded stock like a solar panel manufacturer, say, or you would issue loans to borrowers that are developers of projects. So you'd get an interest rate loan for a set period of time, and that's how you would typically be able to invest directly in renewable energy. We like an equity structure, though, for a few reasons. And the equity structure, what it does is it maximizes your yield potential. So instead of lending at an interest rate to a developer at a fixed rate, you're able to capture the full yield potential of the asset class. You're not capped at that interest rate. Two, it's backed by a real asset. So to use the example of a borrower again, if they default on their loan, you're not out money. You at least in an equity investment, you own a real asset. So in all scenarios, you have a physical piece of property that has inherent value to it. Number three, long-term inflation protected returns. We've been in a period of high inflation in the US. And the concern here is that, let's say the ZAR, and this project to the right is a South African project. It undergoes extreme inflation, and the ZAR is not worth a lot of money. In those scenarios, are you out the revenue that you had projected? And the way we combat that is that the purchase agreements, so the contracts that the off-takers buy electricity back from you, we have them adjust each year to the inflation or the electricity prices of the region. So in an inflation period, your revenue will go up with the inflation. And they're long-term. They're typically 20-year contracts. And for the direct impact of your investment, we feel it's the most straightforward and transparent impact of a dollar spent if it's going directly towards building a specific project. To use South Africa as the example again, this project here is a retirement home in South Africa, in Cape Town. And Cape Town has one of the dirtiest grids on the planet. It's almost entirely coal and diesel combustion. And so every megawatt that's created at this site is directly offsetting dirty energy. It's also a grid that is chronically underserved and often goes offline. So there's an energy shortage as well in South Africa. Okay, so moving on to what Energea has achieved to date. So we went live in the beginning of 2020. And to date, we've raised $130 million through our platform. We've brought online 45 projects across those 3 markets that you saw in the last slide. For perspective, we've created about enough clean energy to power approximately 10,000 US households. And perhaps most importantly, we've been able to generate a realized 12% return for our investors. So we feel that we're proving out over a longer period of time just how profitable this asset class can be for retail investors. And the road ahead for a company like ours, we are the manager of these assets. So the majority of our employees are associated with managing this growing inventory of assets. We're responsible for everything from the financing of these projects on to the monetization of the projects. So managing these assets, raising awareness and education on this new asset class. To bring new dollars in, we've noticed that one of the harder things is to make a retail investor understand this asset class that they're completely unfamiliar with. Everybody's heard of a solar project, but not a lot of people know the financial metrics of a solar project. And finally, we're going to continue expanding into new markets. So we've identified the US, Brazil, and South Africa so far as wonderful markets. They're doing great, but we're going to be turning our head to every new market and try to be a first mover in every new market when they hit when the time is right. So we're excited that by the end of the year, we expect to open up our Colombia market and more to follow in 2025. Okay, great. So that's an introduction to Energea. I encourage anyone watching this to go over to energea.com. We have all the information of our SEC filings and the investments available. You don't have to create an account or invest to get full access to that information, or you can feel free to email me personally at gray@energea.com. So thanks again to Peter, and appreciate it.
We have some Q&A. So the return model, are you levering any of these returns, or is this a straight depreciation?
Yep, it's different from market to market. Our portfolio too, so our community solar in Brazil portfolio has a small amount of leverage associated with it, but very very low in a percentage of the total assets under management in that portfolio. So that's a financial tool that we expect to leverage when the interest rate market is a little bit more favorable to loans. Good question.
Can you explain community solar to the audience?
Yes. Okay, so the revenue model of a solar project, essentially there's an off-taker to that solar. In the US, we often see that in the form of a power purchase agreement. So often this will be a single or a group of companies that will enter into a long-term contract at some agreed upon rate to buy that electricity. In Brazil, there is something called consortiums or community solar off-takers, and this is a group of people that they sign up. They essentially are members of a group, and the group as a whole buys electricity from the power company and gets distributed depending on the amount of demand you have as an individual in that community solar. So essentially, you have the manager of the consortium has the voting rights, and this group that you become a member of is how you determine the pro rata distribution of that electricity. So a little bit different than direct power purchase agreements.
Okay, typically, how long does it take you to site and commission a project?
Yeah, good. Again, this is extremely market specific. We try to, first of all, on the development front, we try to do one project at a time and match up our raise potential with our construction potential. So what we'll do is we'll wait to have that funding. We'll have a new project identified. We'll wait to have that funding. And as soon as it's funded, we'll hit the ground running with the construction team. From nose to tail, we have such a long pipeline. We'll take Brazil as an example. Again, we have a very long pipeline of identified projects with notice to proceed. So projects ready to build. So essentially, we're talking about the go live time is the construction time from when we receive that money. And again, varies a lot by project and by market. Brazil, it's more, you're looking at more like a year to 2 years in operating that project. A lot of factors into that. Interconnection can be very unpredictable in a market like that, but I'd say something around the year to 2 years.
Are there any specific markets segmentation you look at? For example, schools, hospitals, those type of things.
Yeah, so it's about the quality of the off-taker, first of all. So, we do look at a lot of schools, retirement homes, things like that, public sector, big time. But the scale is also a big thing that we look at. We usually find our best financial metrics are in that distributed generation scale. So that sort of 100 kilowatt all the way up to 6-7 megawatt size projects. That's what our niche is. We're certainly not industrial scale, and we're certainly not residential scale. But every project we look at individually, it's about maximized yield and minimized risk.
That was my next question on project size, but you've already answered that. And finally, it seems you have a very good global diversification strategy in that you're looking at markets in different geographies. Can you give us some clairvoyance for the next 5 years, where you think you'll be?
Yeah, a lot of markets have come and gone in our investment committee. We have what we call an investment committee where it starts with a market where we look in depth at a market and we determine, is this one worth committing to? Because it's a large commitment for us. It's a new SEC filing. So we try to choose markets that we think we can invest upwards of $100 million plus in over time and be in there for a decade or more to come. So a lot of markets have come and gone. We've looked at India, we looked at Spain, more in Europe. We looked in the Caribbean, passed on a lot of them. Like I said earlier, Colombia is our next market that we feel really good about. But we're always looking into new markets. There's just so much to consider, and we kind of prefer to watch them for a year or two prior to making any decisions. So that's about all I can give you on that.
Okay, what do you anticipate your typical holding for these assets is going to be?
Yeah, so it's direct equity in these projects. So you own the project, and most of them are newly built, constructed projects. So we look at the lifetime of the asset as a combination of the PPA contracts that we have, but also the warranted lifespan of those projects. So that puts you at around 20 years. Now, to combat that sort of illiquidity of owning an asset for 20 years, because with a retail investor who's putting $100 on a platform, the idea of owning something for 20 years is probably not the window of time they're looking at. We have a very smart and dynamic share pricing methodology that looks at the net present value of future cash flows of all projects in a portfolio and determines a share price that essentially aims at equalizing all investors independent of when you come in or decide to sell your position. So whether you're holding your shares for 3 years or 20 years, your IRR is targeted to be the same. And that's what our share pricing algorithm is based upon.
Okay, great. Well, I really want to thank you very much for giving us a new idea for retail investors. I've been involved with some projects in Europe that went out 35 years on a power purchase agreement, but those were utility scale. So this is a much easier lift, and an access for a retail. I always get inquiries, where can I invest? Well, you're not an accredited investor, but now you can invest in some platform. So thank you very much for joining us today.
Exactly. Well, thank you so much, Peter, for having us.
Okay.